Ladies and gentlemen, welcome to Entrepreneurial Finance, the history of equity financing. If you start your business and you want to finance your business, nowadays you have many possibilities. You can use angels, you can use venture capital, so informal, formal, early stage equity financing. But how did this take place in recent years or in former years? What about SAP, for example? SAP, and we had this example, they started their business and they basically weren't able to finance their business with venture capital because there was no venture capital around. So what's the history of venture capital or equity financing in general? Well, actually, it started very early. It started, for example, with a story in 1901, but there's probably stories which are older, when John Pierpont Morgan acquired Andrew Carnegie's American Steel Company with the help of equity. That was an equity deal, which was not really a financing deal. However, there's probably also financing involved there, but it was an equity deal. And this is when equity, doing something with equity came into place and was basically done in the US in these years by wealthy individuals or families. So the Vanderbilts, the Whitneys, the Rockefellers, Warburg, these families did equity deals at the beginning of the century or in the early 1920s. And this is what you can see also if you look at the development of equity markets. If you look, for example, to Southeast Asia, now we're at the same point that large families basically do the equity financing before the market develops more. The further development of equity financing was after the World War II. First of all, it was relatively modest after the war, but then became more popular in the 60s in the US and transformed a little more into structured organizations. So what we had before, when you look at that chart, we had basically informal family, individual-based financing, and that went over into more formal, institutionalized financing by structured organizations, by institutions that raised funds and then invested those funds into portfolio companies. And that also was typical for the further development. Since in the late 70s, equity financing had the first boom cycle, so to say, with Michael Milken, who popularized the use of high-yield debt and equity for leveraged buyouts. So he started basically buying other companies, taking over all the equity with the help of equity and debt capital, and parts of this debt capital was high yield, so it had very high risk, very high returns. And that was the very beginning of more institutionalized equity financing, but more to later stage companies that were already up and running. The new economy was the start for early stage equity financing, or the boom before, starting in the early 90s, last century until 2000. First of all, KKR started to grow businesses with huge amounts of money, but afterwards then other institutional investors came into place and really did equity investments, and very popular in the late 90s. Sequoia and all those other companies put large sums into internet firms and so on. Well, as I said, there was this bubble, so the market was taking waves there too. However, after the dot-com crash and in the financial crisis, we were able to see that we had relatively low interest rates, so investors basically were looking for alternative investment opportunities. And then it really started with the buyouts again, and 13 of the 15 largest leveraged buyouts were done between 2003 and 2007. And also the scene got more elaborated. Angels came more and more into place. Venture capital worked together with angels. Crowd financing was something which was established, and so on. Greed seems to be legal, so there's many people putting equity in companies. And this is a brief history in equity finance. So we can see it started with wealthy families, then got more institutionalized, and now is the full range of wealthy individuals plus institutions who put money into companies. How did this start in Germany? Actually, same thing. We had two very famous, so to say, entrepreneurs, famous people who also were wealthy people at that point of time, Werner von Siemens and Eugen von Langen, and they helped financing Mannesmann. And that was the start of the Mannesmann company. So it was again private individuals or families who put the first money into companies. And then we had the same development over time, and we had basically then the boom in the 90s, 2000, and nowadays also have the full range of possibilities. Coming to angels, the word business angel, and you could consider Werner von Siemens and Eugen von Langen as a typical, not only private individual, someone who puts money into a company, but also an angel who helped the company to develop. Looking at this development, this started basically in the 1920s when angels or darlings were old little ladies who backed Broadway stars at post-production parties, but not really with the expectancy of returns, just for the fun of it probably. But this is when this expression of angels was built, and it became popular later on in the 80s, 90s, when angels started playing a very, very important role in early stage financing, bridging the gap basically between what the founder can put in a company and venture capital can put in a company or wants to put in a company in terms of larger amount. And to overcome this gap, especially with smaller amounts like 50,000 euros, maybe 200,000 euros for a lower valuation, which might not be so interesting for venture capital because they need a lot of time to also look into that. Angel investors started playing a vital role there, bridging that early stage equity gap. And that was in the late 1980s when there was the rise of the angel scene. And now you can see that everywhere. You have American Nationals Venture Capital Association, for example. They believe that angels put more money into company than venture capital does it. There's also ideas for Germany telling the same. Nobody really can tell. Nobody knows that. However, now what you have is angels basically being everywhere and financing startups for their development.